Okay, so without further ado, let's move on to... we're going to leave that to Roseanne Altshuler and Harry Grubert. Okay. So we're in session 2, the taxation of capital income. Our first presentation is Roseanne Altshuler, professor of economics at Rutgers University, and Dr. Harry Grubert with the Office of Tax Analysis, U.S. Treasury Department. And you're up.
I can't even come close to that. And I'm not going to try to sing either.
Maybe a little bit.
If I have to, I will. Well, thanks for including us in this conference. We look forward to discussing the paper with the group that's here today. You'll notice that the title on the conference agenda is different than the title that we have for the paper. The title on the conference agenda is Reinventing Corporate or Capital Taxation in an International Setting, and we decided that we would reinvent the title and have it be Corporate Taxes in the World Economy. We're going to be talking about reforming the taxation of cross-border income. There's widespread agreement that the current system for taxing cross-border income is a mess. It's complex, it's inefficient, doesn't raise a huge amount of revenue, and various proposals have been put forth to reform the taxation of cross-border income. And now all of the proposals, some of which were put forward by the Tax Reform Panel, have strengths and weaknesses. And the goal of this paper is to evaluate proposals for reform of the taxation of cross-border income within constraints of what is known. And you can see I'm in good company by bolding the theme of the conference, the words that have to do with the theme. Now, the difficulty is that models and estimates of behavioral elasticities that are required for the evaluation are unknown and may ultimately be unknowable. We argue in the paper that principles that have been put forward to evaluate worldwide efficiency, capital export neutrality, capital import neutrality, and more recently capital ownership neutrality, are not satisfactory. They focus only on investment in tangible capital, they make very special assumptions, and they use very simple models. We argue, in fact, that no one-dimensional criteria is likely to be useful. You have to examine all the important responses to a change in tax on international corporate income. In fact, a complete definitive evaluation likely is not feasible. So what is our approach? Our approach is to focus on various behavioral decisions that may be affected by reform in a global economy. So what are those various behavioral decisions? The choice of repatriations, when you repatriate, from where you repatriate profits, how to structure those repatriations, the location of business activity, particularly where intangibles are exploited. And I'll say right now that I think Harry and I are going to address the intangible issue a little bit, which is something that we talked about in the last session. And the location of income, among others. These are the important behavioral decisions that we focus on. And we look to see whether progress can be made along these and other important decision margins. So the question that we really think we should be asking here is, can a reform, for instance, eliminate the unnecessary waste of resources? The possibility of extremely high or extremely low tax burdens that likely aren't optimal or not efficient under any criteria for evaluation, and the income shifting opportunities associated with the current system. So the question is, can reform address these distortions in the current system or problems with the current system, and how well do they do it? Now, we also recognize that the taxation of cross-border income cannot be isolated from the rest of the tax system. Rates are going to have to be coordinated between domestic and foreign income. It's hard to think about a reform that would just address foreign income and put a special rate on foreign income that wouldn't be the same as domestic income. So we recognize that in the paper as we're looking at these reforms. Also, international considerations might alter the analysis of the reform of the corporate tax on domestic income. So one question, for example, that's come up is, and Tom Newbig addresses it a little bit in his tax notes piece recently, is whether expensing dominates a reduction in the corporate rate. Well, we argue that international considerations would tilt the choice towards a decrease in the effective rate. So in other words, getting back to the first point, the taxation of cross-border income can't be isolated from the rest of the tax system. We also recognize that increased globalization may, in fact, justify a change in the mix of corporate and personal taxation within a given revenue constraint. So it may be desirable to shift more of the tax on capital to the personal level in a world with increased capital mobility. So what reform options do we consider? Dividend exemption, and the reform, I'll talk about it a little later in the talk. The dividend exemption system that we look at is similar to the JCT option that was put forward in February 2005, and the tax reform panel plan that was put forward in November of 2005. And just as an aside, one of the things that was said this morning that there's not a lot of interest generated on the business side. Maybe I have it wrong, I'm not interpreting this right, but I think that dividend exemption actually has generated some interest from the business community. At least I've been invited to do a lot of talks to the business community about dividend exemption, so they seem to be somewhat interested. That's number one. The other income tax reform that we look at, or reform within an income tax, is something that we call burden-neutral worldwide taxation. This is a variant of an option that was put forward by Ed Kleinbart recently, both at Brookings and in a tax notes article. How would this work? There'd be no deferral privilege for active earnings retained abroad, and no required allocations of expenses to foreign income. All foreign income is going to be included currently in the base, so not having required allocations is appropriate. So no deferral, no required allocations of expenses to foreign income, and then we would lower the corporate rate so as to keep the overall U.S. tax burden on foreign income the same. And the idea, what we'd be doing here is preserving average or overall competitiveness. So that's the second option that we look at in the paper. We also, because we noticed that tomorrow there's going to be a lot of talk about consumption taxes, we thought, and I probably said something in the abstract that we were given, that we should be addressing consumption taxes. So we do a bit of a review of what is known about the international implications of switching to destination or origin-based consumption taxes. We also talk just a little bit about a proposal that some analysts have put forward, which it would be a border adjustment to the income tax, which we call a destination-based income tax. I will not have time in my 35 minutes today to talk about either of the consumption tax options. I'm just going to talk about the income tax options. Now, international tax seems really complicated, and we like to keep it that way so we seem really, really smart. But in reality, and maybe Harry and I are in just like a parallel reality where we don't think it's all that hard. But in reality, there's only a small amount of moving parts, or that's what I want to argue right now. Let's go through them. When you're looking at a system for the taxation of cross-border income, you want to ask the following questions. Is there a tax on repatriated income? And some options that we look at would get rid of this or the burden associated with it. Current system has a tax on repatriated income. I'll get there. Does the system provide an incentive for manipulating transfer prices, where you're going to see income shifting, incentives for income shifting? Then how do excess credits work in any foreign tax credit system that's set up in a worldwide tax system, for instance? The important question here is, can excess credits shield home country taxes on royalty payments from abroad? So that's another, one of the moving parts. And then finally, do companies have to make expense allocations? Can they deduct overhead expenses like interest at the U.S. rate and then retain earnings abroad in low tax countries? So I argue that, or we argue that these are just the few, simple moving parts of international taxation. And before at breakfast, Charlie said, yeah, there may be just a few moving parts, but when you put them together, it gets complicated fast. And I will say that, but these are the ones that we want to concentrate on, and it really is fairly simple if you were to just concentrate on those. Now I'm going to do the old trick of previewing my conclusions in case I don't get all the way through the talk. You only have to pay attention for a few more minutes. The conclusion that we come to in the paper is that burden-neutral worldwide taxation seems to dominate dividend exemption. It eliminates, and I think this will become clear as I go through the talk and lay out the system again, it eliminates many more distortions in addition to the obvious repatriation behavior distortion. Transfer pricing, the shifting of the location of debt, the need to make expense allocations. It seems burden-neutral worldwide taxation seems to offer much greater efficiency gains. Now, what we would be doing, though, is increasing the effective tax rate on investment in low-tax countries while preserving overall or average competitiveness. So that's part of this plan. And that could improve the worldwide allocation of capital. But it really, as we argue in the paper, it's just not certain within the current state of knowledge. We do not know if capital export neutrality, for example, is appropriate. So whether or not raising rates abroad would improve the worldwide allocation of capital is one of the unknowns and maybe ultimately unknowable in international tax reform evaluation. Now, we recognize that companies that are mainly in low tax locations could find themselves at a competitive disadvantage if we were to go towards this burden-neutral worldwide taxation. So one thing that you might say is, well, just lower the corporate rate further, okay? And that will help out, these companies that were mainly in low tax locations. But there's an interesting trade-off that comes up. If you lower the corporate rate further, you increase the number of number of firms and the size of excess credits. And as soon as you've got excess credits back in the system, you lose. The benefits of the option are diminished. So there's a trade-off there. Now, I'm talking about the rate that we would impose, the revenue-neutral rate that we would have for this burden-neutral worldwide taxation. And this is a really important issue, and this is, I think, one of the contributions of the paper is that we've done this calculation with the Treasury tax files. How low would the rate be? How low could we get this rate down? What would we be giving the corporations? And for those of you that haven't read the paper, here comes the rate. The rate would be the burden-neutral rate on foreign income. This is a significant decrease from the current 35% rate. It's estimated to be about 28%. And I should say that, the usual disclaimer on the paper is this doesn't represent the Treasury Department. But the other disclaimer is that this 28% is not intended to be, nor is it a revenue estimate. It's just our work, or actually Harry's work, with the Treasury tax files. So the burden-neutral rate would be 28%. Now, as the first bullet says, you'd need to coordinate foreign and domestic components of the reform. So how are we going to do that? Well, revenue-neutral base broadening on the domestic side is only going to get us down to about 32%. So that there's a question as to how we would make these rates work. Now, we consider income and consumption tax options separately in this paper, but you could buy down the rate to 28% if you were to introduce a moderate VAT, which is not anything that we talk about in the paper because we're keeping the two separate. So then this does, raise the question of if you're going to rule out a moderate VAT, what are you going to do within the income tax context? And we argue that increased globalization may justify a change in the mix of corporate and personal taxation within this revenue constraint that we're working with. So what we would be doing is lowering the corporate rate, and this would increase the attractiveness. What are the benefits of this? Why might we consider doing this? This would increase the attractiveness of the United States for investment by both domestic and foreign companies. That would be a good thing. And it would reduce the incentive for individual U.S. shareholders to escape the impact of the U.S. corporate tax by investing in lightly taxed foreign companies. So there are these benefits of going to a lower rate. And we note in the paper that, I think this is something that we all know, that rates around the world, and rates in particular in the European Union, have been coming down. We saw a recent article in the Financial Times by the Institute for Financial Studies, and they reported that the EU average statutory rate had decreased by 8 percentage points between 1996 and 2000. So rates are coming down, as we know, and U.S. shareholders can benefit by investing in foreign companies. And so although we don't look specifically at this margin in the paper, a lower rate would certainly decrease this incentive. So in my remaining time, I want to go through the current elements of the system, talk a little bit about what's taxed, the problems with the current standards, review what we know with the theme, keeping with the theme of the conference, and give you our analysis of the income tax reform options. So those were that was the preview of the conclusions. Obviously, if we're going to be comparing, and this is what we do in the papers, comparing the current system to some alternative systems, you really should understand just the basics of the current system. And I went through that already on a previous slide, but let me just quickly go through this again. There's going to be, under the current system, there's a tax on all repatriated foreign income. That's dividends, royalties, other foreign payments. And there's a foreign tax credit. So there's the U.S. tax on all repatriated foreign income, but there's a foreign tax credit against the tentative U.S. tax paid to prevent double taxation. So we have a foreign tax credit. And we also have a foreign tax credit limitation. And this prevents countries that are host to large amounts of U.S. foreign activity from simply hiking up their rates and raiding the U.S. Treasury. So one of the things we point out in the paper is that the justification for the credit limitation has to do with the behavior of governments, foreign governments, and not the behavior or the burden of U.S. taxpayers. So how does this foreign tax credit work? Foreign income is separated into baskets to restrict what's called cross-crediting. Cross-crediting means credits, foreign tax credits on one type of income can be used to shield taxes on another type of income, and I'll get there in a second. So foreign income is first separated into these baskets, and then parent overhead expenses to support that support foreign investment are allocated to each basket of income. The American Jobs Creation Act, AJCA, effectively reduced the number of baskets down to 2 baskets. Now, if a company has excess credits, which means that they have more foreign tax credits than they can use, then the allocation of expenses to foreign income is really a problem. It's only a problem for firms that have excess credits, because having those expenses allocated to foreign income increases the U.S. tax that they have to pay on that foreign income by reducing allowable credits. So what's important here is that we have a provision that is only binding, that only hurts firms in a particular credit position. Firms are either in excess credits, or we say excess limit. They have excess limit. Second, taxation of royalties and other intangible income. Royalties, which, keep in mind, are deductible abroad, can be shielded by U.S. tax, from U.S. tax by excess credits that originate from highly taxed dividends. And I'm going to tell you how large that is in just a second. So that's the taxation of royalties. So we have the taxation of repatriated foreign income, the taxation of royalties. The other thing that you need to know about the current system is that there are incentives for income shifting through the placement of debt and the manipulation of transfer prices. So in the current system, what income is taxed? In 2000, the U.S. residual tax on corporate quote-unquote foreign income was 12.7 billion. Now that, there's a caveat here. The figure really doesn't adequately convey a true effective tax burden, and this is because you've got the definition of foreign income in U.S. law will classify foreign income that's foreign as domestic in some cases, and vice versa, income that's domestic is foreign. So it's very hard to do just a simple calculation of the effective tax burden because of these definitional problems, because of income shifting, because of expense allocations that may be overly strict, and because of you want to take into account implicit taxes, the costs that companies bear to avoid the tax. But that said, the 12.7 billion figure is a good figure to start with, and these elements in the caveat are really important for any reform option. But we wanted to look at the components of the 12.7 billion of revenue, and I think people will find it interesting. We always talk about, dividends and the waste due to the dividend repatriation tax, but a relatively small amount of that revenue that's collected is accounted for by dividends. At most 15% of revenue in 2000. In fact, less than half of the revenues in the general active non-financial basket, less than half of the 12.7 billion of revenue comes from the general active non-financial basket. So that's dividends. Now let's again go to to royalties and intangibles. The taxation of royalties and income from intangibles is of particular importance. We can't ignore it. I mean, maybe it just can't be ignored when you look at international taxation. The exploitation of parent know-how, as I think we all understand, is an important motivation for foreign investment. In fact, intangible assets have become a significant source of FDI, of foreign direct investment. And you can see some evidence of this in the royalty data. The BEA data shows the royalties and license fees that have been received by U.S. companies have tripled between 90 and 2004. And the Treasury files show that there were 45.1 billion of royalties in 2000, but that only yielded taxes of about 5.8 billion for the United States. Almost 2/3 of royalties, of taxes due on royalties, were shielded by excess credits from dividends. So the excess credit, this story is very important because what we have is an incentive to exploit. We have the tax system has created an incentive to exploit intellectual property like patents for new high-tech products abroad, since those returns can escape U.S. taxation through this excess crediting. And there's also an important income shifting story here. There are income shifting opportunities that are created by intangible assets. In a recent paper that Harry has with Jack Moody, I think I have the right paper in mind, royalties represent less than half of the contribution that parent R&D make to subsidiary income. So what this is saying is that royalties are being underpriced, okay, and income is being retained in low-tax jurisdictions. So the bottom line is that our tax system can affect the choice between exploiting intellectual property at home and abroad. So that's the section of the talk where I tell you a little bit about the data. As far as the efficiency criteria, several standards, and we're assuming that the audience is fairly sophisticated here. At least they know what sen, sin, and con are. Several standards have been proposed for the evaluation of worldwide efficiency. And as I said in my introduction, all of them focus on investment in tangible capital. But if you want to do a definitive or a comprehensive analysis, you need more complete models. So we argue that none of these take all of the important decision margins facing companies into account. They don't take income shifting into account. And you have to recognize that opportunities for income shifting can alter effective tax rates abroad. Everything is interrelated here. They don't take income shifting into account. They ignore the presence of intangible capital. And one has to recognize that intangibles can affect the relationship between investments in different locations. And finally, these models are based on very special assumptions for which there's very little empirical evidence. So capital export neutrality makes this extreme assumption that all investment by U.S. companies comes from a fixed pool of capital that's available to the U.S. corporate sector. And sin and con, capital import neutrality and capital ownership neutrality, seem, on the other hand, to assume that capital is supplied at a fixed rate by the integrated world capital market. So which is right? Well, we don't know. We don't know which assumption is right. I mean, I guess it could even change over time. So we don't know whether CEN or CIN or CON are optimal. And so what this suggests to us is that what reform can hope to accomplish is the following: the elimination of waste associated with the corporate tax, and then a reduction in the occurrence of very high or very low tax burdens abroad, which can't be justified under any standard. It's hard to imagine that they'd be justified under any standard. So what we're looking for is elimination of waste and elimination of these very high or very low burdens. So what we do in the paper, and in this sense, the paper is similar to what has the similar layout in this part to what we heard this morning, which was kind of a literature review or a review of what is known. What we do is we list the behavioral margins that we're concerned with, and then we, in the text, we go through what is known, and then I'm going to give you a little bit new information. And I'm going to go through this quickly, because what I really want to do is just hit the behavioral margins. Location of tangible capital. Here I think we could say we know a lot. U.S. multinationals are sensitive to variations in effective tax rates across locations. Very sensitive, surprisingly sensitive. Investment choice, however, across the locations doesn't seem to be sensitive to repatriation taxes. Location of intangible capital. Well, this can only be identified indirectly, but BEA data suggests that low-tax countries are becoming much more important destinations for U.S.-produced intangible assets. We have some information in the paper about royalties accounted for by operations of U.S. multinationals in Singapore and Ireland, and they're just doubling and just growing in importance between the early 90s and today. So location of intangible capital, another behavioral margin. The repatriation decision. What is known? Harry and Jack Moody and Desai, Foley, and Hines have estimated or come up with estimates of the implicit cost of retentions, and that they're about 1% of total subsidiary pre-tax income. So this is the burden of the repatriation tax. And Harry has a estimate, I also think, with Jack. Costs of repatriation tax avoidance strategies are about 1.7% of income in locations, in low-tax locations, which are locations with effective tax rates less than 10%. So we know something about the repatriation decision, the cost of the repatriation tax. We're going to revisit that. Income shifting, again, one of the simple, what I'm claiming are the simple elements that we need to be looking at. A comparison of the 96 and 2000 Treasury data suggests that income shifting seems to be getting worse. The strong relationship between profitability and local statutory tax rates that's been found in existing studies is getting stronger. The most recent evidence, for instance, from Treasury files show that profit in a country with a 10% tax rate is almost 2 times higher than reported profits in a country with a 40% rate. Okay? So income shifting, it seems to be getting worse. In terms of other important margins, I'm going to skip ahead for time. We're interested in how the current system and reforms of the current system affect incentives that corporations have to lower foreign tax burdens. Export decisions, that's another whole margin that we discuss in the paper, but I won't have time to discuss here. And then another margin are the host government decisions regarding the taxation of U.S. companies. Our tax system can affect the incentives that the foreign governments have to attract U.S. companies or to play with their tax policy to benefit their home country. And the note that I have on the bottom here is that all of these decisions are interrelated, making the analysis very difficult. And just as an aside, I have to say that my head almost exploded when I was working on this paper, because it was just so hard to think about all of these margins at the same time. I don't think that can really happen, but I did have I was scared that it might. New evidence. So one of the things that we did a lot in this paper, we just couldn't stop ourselves. But we have a little bit of new evidence on the behavioral margins, and part of this is because the new data is up, and you always want to look at the new data, and part of it is because we have this AJCA experience. You know, I talked about the cost of retentions being fairly low, and Harry and I thought, well, you know, do we have this wrong? What about the experience with AJCA? As Kevin was saying, there was a repatriation tax holiday in 2005. Under certain circumstances, U.S. multinationals could repatriate at 5.25%. And they apparently brought back hundreds of billions in response to the tax holiday. So could the implicit cost of deferral be 5% or more in low tax locations? We decided that we'd experiment with some new specifications to test whether or not the efficiency cost of the tax that had been estimated in the previous literature was in fact underestimated. And it's possible that the cost of the repatriation tax declines as accumulated profits get large. So in other words, that the repressing effect of the repatriation tax would decline as a firm accumulates more and more profits. What we found briefly is that the old specification did not seem to underestimate the cost of retentions, the implicit cost of deferral. However, it is very difficult to measure the actual repatriation tax due to transitory perturbations, and this is something that's been addressed in the literature before. So we recognize that errors and variable problems likely bias the estimate downwards. So we probably have an underestimate of the cost of repatriations. So that's the new evidence on repatriations. We also have some new evidence on income shifting. This is kind of neat. We use the existing income shifting equations. These are the equations that show the relationship between local statutory rates and profitability. We use the 2002 Treasury file. That's the one that's up and running now to make rough estimates. And so we have now an estimate of the efficiency cost of income shifting. And I think that Harry and I were both a little bit surprised that the figure is fairly low, 1.7% of pre-tax income. And Harry can correct me if I'm wrong, but I think we weren't sure what to expect, but it seemed a little low. And then also estimated the company's net gain to shifting is equivalent to just over 1% of pre-tax income. So we've got this new information about the efficiency cost of shifting. But we also, in the paper, stress that it's very important to understand the relationship between income shifting and effective tax rates, the link between tangible and intangible investment that firm is very important in international tax. And I think the first paper was a paper that really addressed this, was the Puerto Rico paper that Harry and Joel Slemrod did. Production abroad with a large intangible component can generate negative effective tax rates due to the income shifting opportunities that I was talking about. Just to give you an example, we do an example in the paper. But the Treasury 2002 files for controlled foreign corporations, so these are foreign affiliates abroad in manufacturing, indicate that pre-tax profits over sales is almost 3 times higher in Ireland than the group mean. So that, presumably what's going on here is very valuable intellectual property is being located in Ireland, and royalties are being paid back to the U.S. that don't fully reflect the contribution, driving down effective tax rates in Ireland. So what's important about this slide is understanding the links between income shifting and effective tax rates, tangible and intangible capital. Okay. How am I doing on time? Okay, I can do it. Dividend exemption. The first slide just lays out how dividend exemption is going to work, and I think that we can skip through that except to say there's going to be no repatriation tax. Income deductible abroad would be taxed in the U.S., so that all income is taxed once. This means that royalties and interest paid to U.S. parents are taxed at the U.S. rate. That's why there's interest in dividend exemption. Okay? Expense allocation rules would be imposed. And so that's the proposal. I'm assuming that people are familiar with dividend exemption. So what's the evaluation? And here we just go through the margins. Okay, of course, the efficiency cost of the repatriation tax is eliminated, but there would be no excess credits to shield royalty payments and export income. This is a big change relative to current law. So this eliminates the tax benefit to exploiting intangibles abroad that comes from the ability to shield royalties from U.S. tax. Expense allocations are now going to be relevant for all companies. So companies that under current law that are in excess credits are no longer going to be able to benefit from being able to deduct expenses at the U.S. rate while retaining low tax income abroad. So those very low effective tax rates abroad are going to go away. But there is income shifting. There still are income shifting incentives, but we make the point that it becomes more attractive under dividend exemption only to the extent to which that repatriation tax was a burden. So if it wasn't a burden at all, it's just as attractive now as it was before. So there's uncertainty, in any evaluation, and in particular, the uncertainty here has to do with transfer pricing and also the incentive to understate royalties that will arise with dividend exemption. Now, the burden neutral tax, I think I explained, and I'll be able to wrap in like 1 minute. So I think I explained how this system would work. No deferral, at the same time, no allocations, but there would be a foreign tax credit, and we would reduce the tax rate on foreign income to maintain overall or average competitiveness. Okay, so finally, the evaluation. As I said in my preview of the conclusions, burden-neutral worldwide tax seems to dominate both the current system and dividend exemption. Let's just go through the margins. There's no efficiency loss associated with repatriation. There's no incentive to engage in income shifting. Companies don't have to make expense allocations. I didn't put it on the slide, but the tax system doesn't affect finance decisions. The tax system is simpler and it's less wasteful. So it's sounding very good. However, the attractiveness of the policy ultimately depends on the extent to which firms find themselves in excess credit positions, because as soon as we have excess credits, we're back to the old system in terms of some of the bad incentives. So we have the burden neutral rate that's not a Treasury estimate of 28%. At that rate, we said what percentage of active foreign source income would continue to be in excess credit. This is fundamental. And it's about 30%. Did we tell our discussants that number was different? Or what did we have? Now I don't even remember. I don't remember what was in the paper. 25? Yeah, we did. We found that it's 30%, but it's really the petroleum companies that are driving that high percentage. It's about 18% of the foreign source income of manufacturing parents. So only one person read the paper, but that's much better than my classes back at Rutgers. So there'd still be these. This is worrisome because you still have the excess credits. The policy creates winners and losers. Companies that operate mainly in low-tax locations will find themselves at a competitive disadvantage. What may happen? You could have inversions. And we note in the paper that the JCT put forward a new proposal on inversions that was adopted by the tax reform panel. If you were to lower the rate any further, you'd have more firms in excess credit. And what I've done on the last slide, John, is I have just put the conclusions together. Burden neutral, we're going to have a substantial cut in the corporate rate with this worldwide tax system to about 28%. We'd have to reduce the effective rate on domestic income. We have some uncertainty regarding expatriation incentives and competitiveness concerns. But then finally, We just want to stress that increased globalization may actually justify shifting more of the taxation of corporate income to the personal level. And, you know, it would, as I said before, increase the attractiveness of the U.S. for investment by both domestic and foreign companies and reduce the incentive for individual U.S. shareholders to escape our tax by investing in lightly taxed foreign companies. That's it.
Thank you. The first discussant will be Roger Gordon, who will need to leave on comments because we're running late.
All right, well, I'd like to thank John and George for inviting me to this conference. And I'm particularly happy to talk about this issue of international taxation. In the past, I sense that this question has been a footnote in tax reform discussions. And I'm delighted to see it's now taking a much more central role, both here and even in the President's Tax Reform Commission discussion. The current law in the U.S. is to tax foreign income at repatriation. This has been a common provision internationally. The UK does the same. Japan does. You know, two of our key trading partners. But not all countries do. And I think it's increasingly come under debate internationally and not just in the U.S. This paper focuses on 4 particular alternative policies which Roseanne discussed. Trying to think through these proposals carefully, I think, is very timely. 2 of them were discussed in the President's Tax Reform Commission as part of 2 different proposals. Since policy differs across countries, we have the potential to try to make sense, looking internationally, what the effects of these alternative provisions might be. The dividend exemption is the law in Germany, in France. Canada, it's done on a bilateral basis, but for most of its trading partners, it's under this dividend exemption system. So we have experience elsewhere with how this system would work relative to our current system. The burden-neutral worldwide taxation, I believe, is used in New Zealand, but otherwise we don't have any international experience with it. The destination-based tax, that's a VAT. Most countries except the U.S. Have this, so there's plenty of experience with how that works. An origin-based tax, a tax on production, is like an excise tax. And again, we have some sense of how that might function based on experience elsewhere. The paper provides a very rich discussion of the many types of behavioral responses to the current law, and much of the evidence, in fact, comes from work that Roseanne and Harry have done. So very much merits highlighting. It's too complex to provide any serious summary here, but let me try to draw what I see as the key points. One is dramatic income shifting across locations. We would expect a low profit rate pre-tax in low tax rate countries because there's little tax paid, and the pre-tax profit rate has to be higher to compensate for tax payments. We see dramatically the opposite, with much higher pre-tax profit rates in low tax countries and very low profit rates in the highest tax countries, and low profit rates in the U.S., particularly for foreign-owned multinationals here. The question is why this occurs, and the past work that Harry and Roseanne have done suggests that intra-company loans and location of patents provide important mechanisms for shifting income across locations. The parent or the subsidiary in a high-tax location will borrow from other parts of the firm, deduct the interest. The patent will be located in Ireland or Singapore in a low-tax location, and the firm in the high-tax country will make royalty payments, which are deductible there, providing income in the low-tax country. Transfer pricing is another. So there's a lot of flexibility in avoiding the tax even on domestic profits due to these mechanisms. Our tax system attempts to tax these profits, at least at repatriation. What we find in the figures that Harry and Roseanne provided is that we collect very little revenue on these repatriations. Firms find it easy in practice either to avoid the tax or to avoid repatriation and find other means of funding activities. They focus more on these financial responses to the tax, less on real behavior, and I think that does reflect the evidence we have to date. Then the question is, given this evidence, how do we then think about tax reform alternatives? They discuss, there's two traditional criteria that have been in the literature for a long time. Peggy Musgrave raised them in the 60s. Capital export neutrality, capital import neutrality. They add another that Mihir Desai and Jim Hines have talked about, capital ownership neutrality. I've never found these criteria helpful in thinking about international tax issues, and I think the authors here agree. One question is that, their focus is on worldwide efficiency. And it's not clear why the U.S. in setting policies should be concerned about worldwide efficiency. We're concerned about our own self-interest. And it's a leap to think that our self-interest implies these criteria. In addition, we can't satisfy all of them. In fact, some of them we can't satisfy at all, necessarily given our own behavior. We would need cooperation with other countries. If there's a trade-off in satisfying better one criteria, less another, how do we make that trade-off? There's no discussion here of an objective function. And as the paper emphasizes, this discussion of these initials, Sen, Sin, and Con, don't mention income shifting at all, which seems to be the dominant behavioral response to the existing tax system. So they're really not a good starting point. And yet, to think about the questions raised by the paper, I find it hard to proceed without having some framework in which to think what should be done and then how do particular proposals compare with it and what are the effects of any differences between proposals and what our theory at least would suggest. So I'm coming at the same questions from a different starting point, but I think end up in the same place. The starting point that I take here is a standard one, that our objective in thinking about policy is to maximize what should be a sum of utilities for different people, plus some function of government revenue in the U.S., where the utility of individuals depends on the wage they can get in different types of occupations. See, here could be company, or the rate of return they could get on investments are in different companies, each net of taxes. If we do this in a closed economy setting, there'll be substantial debate about how we should tax capital versus labor. That's been the focus in the literature, but I think almost complete consensus would be that we should tax labor income at the same rate regardless of the company you work for, and capital income at the same rate regardless, again, of the company you invest in, or further, the type of security that you buy. You don't necessarily have that, but that's what would come out from the optimal tax literature. So that's what I'll call a level playing field. If we then try to take that model and extend it to an international setting, we have to think through what these things mean. R would be investments in different countries rather than different companies. The labor income I view as analogous to the royalty income that Roseanne and Harry focus on. This is a return to our ideas exploited abroad. And so the income we get from our ideas is our own labor income. It's a return to our intellectual effort. And so then the question is how it's taxed. And the tax rates here are now interpreted as the U.S. rate only. The WCRC would be what's net of local taxes in the foreign country. That's what we as a country earn from an activity abroad. And then the question is, what does this model say about the tax treatment of foreign source labor and capital income? The answer will be the same. It will suggest a level playing field, which means the same effective U.S. tax rate on labor income regardless of the source country, the same effective tax rate on capital income regardless of the source country. This avoids any U.S.-created distortion to the location of activity. So again, a level playing field. What does this mean in practice? For labor income, this type of tax could be implemented in a couple of different ways. One is, in the U.S., if we have income reported within a firm as returned to ideas, we tax it at accrual under the corporate income tax, and then at distribution when it's paid out to the individual who created the idea. To do the same, if the idea is exported abroad, would require taxation at accrual of the profits earned as a result of use of those ideas. But an alternative would be to tax the resulting income not at accrual, but at repatriation. This is equivalent between taxing wage income now and taxing pension income, but allowing a deduction, no tax now as the income is accrued. So either would allow full taxation of labor income. But it's taxation not of dividends, full taxation of capital gains, any other source of income from abroad as occurs with taxation of pensions. For capital income, to have the same tax rate on activity abroad as would occur for income accruing within the U.S. Alan has ideas on the capital gains taxes and how we might defer the liability, but in practice, we'd require worldwide taxation at accrual. Now, these proposals together would satisfy capital export neutrality, where tax at the same rate regardless of where activity occurs. It does not lead to capital import neutrality or capital ownership neutrality, and yet this is what comes out of a standard type of optimal tax argument. Now, one other implication of this model is that if we think about the domestic tax treatment of foreign-owned subsidiaries in the U.S., it has some striking implications. If the U.S. is a price taker in this international market for FDI, then the return to these investments should not be taxed. This is basically an optimal tariff argument. Only to the extent that we're not a price taker in international markets should the FDI in the U.S. be subject to tax. So if Honda sets up a plant here, it wouldn't be taxed even if GM, Ford, and Chrysler are. Now, that's an uncomfortable conclusion, but it's coming out of the same model. Let me come back to that later. Now, I haven't mentioned tax crediting. Roseanne thinks this is straightforward. I'm not going to touch the richness of the discussion in the paper, but let me give some hints of how the conclusions I just gave you changed once we take into account tax crediting. With tax crediting, assuming firms are in excess limit situation, they still pay the U.S. rate. So the utility is unchanged, but U.S. government revenue does change because the foreign country gets the first take at the income, and we give a full credit for that, and we only get the residual profits. So in terms of national welfare, we're better off if the income is reported here and not abroad because we get all the revenue, rather than, can you read it?
10 minutes of that.
Oh, all right, so that here we'd like to have a lower tax rate on domestic income, a higher tax rate on foreign source income under U.S. law in order to pull the income into the U.S. rather than having it reported abroad. All right, I then went through the four proposals, basically coming to the conclusions they did. That the worldwide taxation accrual and the destination-based tax do tax foreign source labor income. The worldwide taxation accrual taxes foreign source capital income. The destination-based consumption tax obviously doesn't. The other two proposals don't tax either source of income abroad. So introduce distortions favoring activity abroad. The one complication I wanted to raise is that the model I just gave you has two types of behavior that it doesn't take into account. One is cross-border portfolio choice. It assumes that U.S. firms are owned by U.S. residents, period, and all our savings occur through U.S. companies. So to tax our savings is equivalent to taxing income to U.S. firms. and we do that regardless of where they invest. If we can escape that tax by investing in foreign firms, a new dimension is added that complicates the previous analysis. I mean, another type of response that introduces the same complication is if a U.S. firm shifts its nationality, sets up a foreign front company, and has the investment occur through that. If we introduce, now the problem is that these two types of behavioral responses we don't know much about, because under a territorial system there are no such distortions. And our current system, as they've argued, is close to a territorial system, so we really don't know how the system would behave in response to introducing distortions there. And worldwide taxation introduces a particular distortion there, because if we tax income abroad if we invest in it through a corporation, we don't if we invest in it through an individual. To do the equivalent, we'd have to have an accrual tax on individual investments abroad to match what happens if you invest through a U.S. firm abroad. So I think that there are unknown distortions created by worldwide taxation that we don't have experience judging. So in conclusion, I basically agree with what the paper has found, that worldwide taxation is consistent with the basic theory we use, but I think there are real questions left about types of behavioral responses where we don't have experience yet from the U.S.
Thank you. Our second discussant is Professor Charles Ballard of Michigan State University.
I know we're behind schedule, so I'll try to be brief, but not too brief. I want to thank George and John for inviting me. Since I was born and grew up in the Houston area, it's a special pleasure to be back here at the Golden Buckle on the Sun Belt. And to commemorate the occasion, I'm going to wear my 1962 Houston Colt 45s cap. If you don't know what the Houston Colt 45s are, you can ask George. All right. Now, Roseanne was a little bit ambivalent about whether this stuff is hard or easy. She tried to convince us there for a while that it's easy, but then she said that her head was about to explode. I will tell you that there are a variety of possible interpretations of the various things she said. For me, it makes my head explode. I find this to be one of the more difficult aspects of empirical economics. It's a very complex area. Now, there's a possibility that I'm just stupid, but I'm going to try to hold out for the interpretation that I'm at least of average intelligence. They're really smart, but it is in fact very complicated stuff. As she said, you've got a lot of features of the law. She mentioned several of them in the talk, and there are a few others that are mentioned specifically in the paper. You've got transfer pricing, interest stripping, resource and development allocation rules, separate baskets. One that I don't think she mentioned in the talk, but which is mentioned briefly in the paper, excess credit carry forwards and carry backs. And then there are all sorts of, there's also subpart F, variety of other policy issues that we sometimes get into, overall versus per country limitation, branches versus subsidiary definition of what is a controlled foreign corporation. There's the sales source rules. So there's just an awful lot going on. So let's see. Did I press the right button? Oh, there we go. Oh yes, okay. It's so known. I'm emphasizing the known. It's very, very complex. A good aspect of that is that it gives jobs to people like Harry and Roseanne, and others in this room have contributed to the literature. Disadvantage is the resource allocation and the waste of time and energy and money in devising and implementing the tax avoidance schemes. I want to echo the authors in saying that I'm not a big fan of sin, and con. I especially think that we in this sub-profession need to do a better job on choosing our acronyms, because anything for which the acronym would be sin or con can't really be a very good basis for discussion, I think. One thing that's known is that there are a lot of margins, and that's one of the points of emphasis of Roseanne's talk. Our empirical knowledge of some of these margins is pretty good. Our empirical knowledge of others is not very good. I think they've done a good job of showing some of the deficiencies. Here's one from their paper. At this point in our knowledge, we do not know whether the high profits in low-tax countries constitutes income shifted from another foreign country or income shifted from the United States. And obviously, that's something about which we would really like to have a lot more precise information than we have. Also, one of the ones that she mentioned that we do know, or that we think we know, is that investment choice across locations does not seem to be sensitive to repatriation taxes. Well, that I would put in the category of something where we think we know, but I don't fully understand why we know what we think we know, because it seems like there's money that's being left on the table by somewhere, and I think so that in addition to nailing down our understanding of what we think we know, we'd also like to nail down our understanding of why the things that we think we know are the way they are, and I think there's a lot more research yet to do in this area. Given the uncertainties, how do we decide among the policy alternatives? And I think Roger has given some comments about how to do that. I'm going to go quickly. I think that Harry and Roseanne have made a good case for what they call the burden-neutral worldwide option. So that's a known. It's also a known that, I just said that I think they've made a good case, therefore it's known that I agree. What I don't know is whether the rest of the folks in this room agree with that. And one thing that I hope we can do today and tomorrow, certainly within the context of the taxation of foreign source income, we have in this room a non-random selection of the people in the world. We have several of the folks in the whole world who know the most about this area. I'd be interested in hearing what others have to say about this, as well as about other issues of empirical analysis and other issues of policy that come up during this couple of days. Even if we have a consensus, which we may or may not among ourselves, another question is, can we convince the public? And so I'll put a known. Well, yes, of course, it's time for fundamental tax reform, and my guess is that there would be nobody in this room who would disagree that it's time for fundamental tax reform, and yet, if each of us were to describe our most preferred policy for fundamental tax reform, we probably would not all come up with exactly the same thing. That's my sense from some of our discussion earlier. Another thing that I think is absolutely known is that it won't be easy for the public to undertake reforms that we economists prefer. And let me just give you a sense. I've been more involved in Michigan tax policy than I used to be, and right now we've got a debate going on about what we should do with this thing called the single business tax, which is a peculiar feature, sort of a cousin of an addition-based VAT that we have in the state of Michigan that's unique to our state. And everybody's dissatisfied with it, and it looks like it's going to be removed. But the whole concept of what for us in public economics is a very natural way to go about our discussion, which was really the foundation for this paper, which is what we're looking for is, let's look for things that are revenue neutral but which are efficiency enhancing. That's an extraordinarily natural thing for a public economist to do. Revenue neutral but efficient. I hope I didn't scare you away. Revenue neutral but efficiency enhancing. Well, there are two sides to the debate in Michigan, and nobody is talking in terms of that. Because on the one side, you have revenue slashers. You have people whose primary goal is to reduce the size of government, and we're already about 3 percentage points of personal income less than we were a generation ago in terms of the amount of revenue raised for state and local government in Michigan, but let's slash it further. On the other side, you have folks who, in my view, rightly don't want to further emasculate social services and education, but for whom the whole discussion of efficiency is sort of a foreign language. And so you don't have many people who do what we here in this room do instinctively. And I think we got a big public relations problem on our hands trying to convince the rest of the world that you need to take a close look at these issues. Finally, one thing that we haven't talked about much, maybe, I don't know how other folks are worried. Larry mentioned the whole issue a little bit of maybe we'd inflate our way out of our current account deficit. I think regardless of what Ben Bernanke does, we may be forced by currency markets to make some severe adjustments in the next few years. It's hard for me to believe, although I might end up being surprised that the rest of the world will continue to want to soak up $500 billion a year of dollar-denominated assets. I do think that the long-term trend has to be for a falling dollar. I hope it doesn't fall much between now and my trip to England and France this summer. But I think we're going there, and a sufficiently large shock to currency exchange rates could really, I think, swamp some of the effects that we've been talking about here in terms of the tax treatment of foreign source income, and so that would be that context is something about which I'd like to see additional discussion. Yeah. Did I get done in under 10 minutes? Maybe. All right. All right.
So now we'll come up and we'll have. We started 20 minutes behind, and we have 5 minutes officially left in the session. We'll allow 10 for questions, and then we'll make it up somewhere. Let's take a few questions. We've got Hassett, Newbig, Yen.
So you're talking about hard to understand. I have this problem that this international tax conversation seems like it's talking about Mars and it should be talking about Venus. And so I always get kind of just discombobulated watching these conversations, because we're starting from like, if we look at the domestic economy, we've got, say I've got a null that Judge and Chomley got it about right about what the optimal tax looks like, and so we've got way too much of a tax on capital, and so then if we introduce this tax haven where I can sort of do some hijinks and lower my tax on capital, and then still keep some activity domestically, like there's some papers that suggest there's complementarity between foreign and domestic operations, then effectively what I'm doing is moving us towards the optimal tax. And so, like, this whole notion that, like, the fact that we created this opportunity to do hijinks to lower the domestic tax, and that's bad, seems to me that needs to be justified in some kind of dynamic model that people use to study capital taxes. And so I'm not saying that in the end you might not end up like so. For example, you probably have all sorts of neutralities if the capital tax is zero everywhere. Right, but we're in the second best world, and I think that to understand what's going on with Ireland and everything else, we need to think about that second best world more than we do.
Well, we sort of tried to introduce at least we recognize we're in a second best world, particularly if you have this, contrary to the assumption in Rogers' sort of level playing field model, that there's a worldwide capital market portfolio flows. Now, and we can see we don't know the cross-elasticities. What I do know is that the ones that Hines and Desai estimate are wrong, because it's based on econometric. And I find it very hard that sort of somehow that Germany some of the benefits by the existence of a tax haven in Ireland or something like that. Why didn't Germany just lower its tax rate by itself? It could by disfavoring German U.S. companies. But I think that where we can see that it's an open question. That's why we don't take it strictly. We don't say that the level playing field conclusion is basically the correct one. We're willing to. We recognize this competitiveness argument. That we recognize you're going to raise the effective tax rate in Singapore and Ireland, and for all we know, the companies are going to say, "Oh, well, that's mean our German and Japanese competitors will have an advantage because they can enjoy either dividend exemption or deferral." So that's we admit that level of ignorance. Now we are maintaining overall competitiveness, and clearly with the system we have now, with all that income shifting, you can get the large negative tax rates.
Right.
Like in Puerto Rico was the extreme example that Joel and I analyzed, where you probably had negative tax rates of 200% or 300%, and then maybe in Ireland and Singapore it's not quite that large, but it could easily get you below zero. So. And we think that's sort of probably, at least for they would be more than competitive with the local Irish firm. Now, whether it depends on the opportunities that other companies, that companies based in other countries like Germany or Japan, what provisions they have. But that was the unknowable, which we can see.
Yeah, the unknowable is you don't know whether or not low effective tax rates abroad are bad, but we posit that very, very negative effective tax rates abroad probably aren't going to be optimal. And that's what we have now.
I thought the paper did a very good job of laying out some of the additional margins that aren't taken into account in most of the prior work. And so it was very helpful kind of simplifying it for me. I guess you mentioned in passing 2 additional margins, but they don't seem to be in your criteria in terms of considering the worldwide versus the dividend exemption. You mentioned that with worldwide burden, that other countries might increase their tax rates. And I was wondering, do you think that your revenue neutral rate or the 28% rate would have to change if Ireland all of a sudden went up to the U.S. and the UK rate? There's a recent paper by Bill Randolph at CBO that certainly suggests that there's some convergence toward the UK and U.S. statutory rates. The other margin that you mentioned in passing is the inversion Roger referred to as choice of nationality, and how much of this converts, the worldwide burden would convert it to a sort of origin base tax that has this location decision effect.
Well, on the inversion issue, that's a possible issue. Now there are limits, the extent to which, as you know, in Section 367 of the U.S. tax code, if you have valuable intangible, the extent to which you can invert, because you'd have to pay a toll charge, and companies are reluctant to do that. If Microsoft wanted to invert, or Coca-Cola, and you could, I think, as Roseanne mentioned, that both the tax reform panel and also the joint committee proposal of the change in what was called how you identify the residents of U.S. companies. And I think one suggestion is to go both either to incorporation, which is the system we have now, to incorporation plus place of management, which is what the British have. Now, that in the past, that has meant that you would have to have a board of directors meeting in Bermuda once a year, and you would manage to establish a Bermuda residence. But presumably, you could have a stricter definition. There's also definitions based on where your stock is primarily traded. So, but that does raise the issue: what should mean by the residence of the company? What makes Microsoft a U.S. company? It seems to me it's where the intangibles are produced. Presumably what's valuable, as Roger said, is produced in the U.S. and should be in the U.S. tax base, just as it is with exports. And in terms of the response of foreign governments, I think that is a serious issue, which we mentioned. Now, you could try to deal with it in some ways. I'm not sure how feasible. You could have a per-country credit, so at least you couldn't go above the U.S. rate of 28%. And per country credit would be feasible under a no deferral system. What makes it impossible under the current system is you have all these intercompany payments, so you can't trace the credits and the income going up through the tiers. But that would be unnecessary, because you just would look at the active income and just tax it. Dividends would be irrelevant. George.
Roseanne and Harry, I like your paper. Just on the one little point that you just made, Harry, I think the joint committee proposal and the tax panel proposal on choice was tougher than the UK rule. That is, they didn't include really a board of directors meeting. So,
No, I know.
Yes.
I have though a couple of questions on the burden neutral worldwide plan, and specifically the simplification benefits, because you've indicated your efficiency criterion is reduction of waste, which I assume means tax planning, tax complexity, things like that. One thing I wasn't clear on is apparently the plan would include not worrying about the allocation of deductions, and yet I guess my assumption is you're going to need certainly as robust, if not more robust, foreign tax credit limitation rules in that system. I would think at least to pre-2004 rules, maybe going back to 1986 type rules. And so it wasn't immediately clear why allocation and deductions still isn't at least an issue at some level. The other question is in terms of the rates, the way that plan would get the burden neutral, if you will, is to reduce the tax rate. And here I saw kind of a couple of issues. One is if the reduced tax rate only applies to foreign income as opposed to domestic, then of course you've created another wedge, and you've got source rules and transfer pricing rules and allocation deduction rules and so forth in space. If, as well as you indicated, exacerbating the foreign tax credit limitation issue of the excess credits. But if you further go, as you suggest, to reduce both the corporate tax on foreign source and domestic source, so you get, let's say, you get both down to 28%. It seems to me you now create another wedge, which is the difference between corporate taxation and household taxation. You may remember in Treasury 1, the original plan that they came up with, the revenue neutral plan, was for a 28% corporate rate and a 37% household rate. And remember, Don Newman said, oh, household rates are no good because it sounds like a football call or whatever. But the main issue was, of course, the spread between the two, which presumably is going to create a big tax shelter issue. And so, there is a way around that, and particularly since you're talking about multinational. The most obvious way, it seems to me, is you kick out all the non-public companies out of the C regime, because they're the ones that are really going to create the pressure when you've got a spread between 28 and 37% between household and corporate. But of course, that's a big political issue, which you're well beyond the scope of anything that you're going to be trying to address. But I mean, so I do think that there is another wedge there that is created. And obviously how you solve it.
I think that's right.
Yeah.
So between 20 to 35%, and I think we should have mentioned that. I think we sort of among ourselves we discussed this. So it would make it difficult to go down to 20%. Like we've had some discussions with the major tax planners in Washington, which we happened to run into. When I mentioned the 28% rate to them, they said no, the companies won't accept it unless it's 20%. So 20% is clearly too low unless you had something like the Gratz plan where you had an add-on VAT and you lowered all rates.
The add-on VAT will do it.
Including the personal rate.
All right. We have two very quick questions, hopefully. Arnold. Dan.
A couple very quick points. One, something I just do not see is how there is any incentive for an individual shareholder to move his money from a low tax to a low corporation tax to a high, from a high corporation tax to a low corporation tax activity. It seems to me that it's after-tax income that is being capitalized into the share price. It's predictions about after-tax income that one is really thinking about when one is shifting portfolios. And I would think that for myself, in the modern world, if somebody still has a 50% corporation tax rate, I would like to buy that, predicting that that rate will have to go down. So therefore the stock will go up. So I would go almost the other way. The other puzzle is, the other different point, on this efficiency cost of income shifting. You got an efficiency cost of 1.7% of pre-tax income and a net gain to the movers of 1.0% of pre-tax income. And this sort of puzzles me. I think of a case where you have a given income of 100, which would be taxed at 30, so you would have 70. Now you're moving it to a place where that same 100 would be taxed at 10, so you have 90. Now, I'm going to have some efficiency cost of that more, so I'm not going to get the full difference of 20, but what I don't have of efficiency cost, I should be getting in gain. So my gain to the entity that does the moving should be the difference between the potential of 20% and the efficiency cost that you're right.
We have the arithmetic in the paper. There is one assumption. We made this linearity assumption, which you probably wouldn't object to over this rate in terms of the cost. And I think the arithmetic was correct for you, and you need the difference in the tax rates, as you said. But also the question is, what tax rate is there's this extra cost, say in terms of tax planning, presumably of extra lawyers and accountants you have to pay for, and at what tax rate is that deductible? We assumed that it was deductible at the high tax country rate.
I'm just going to say mine is like a sentence.
Okay.
Oops, there's a sentence already. No, I would say at a first approximation, the burden neutral tax would simply save the repatriation, the distortions associated with repatriation, and nothing else. I mean, obviously, in more sophisticated, there can be gains and efficiency gain and losses, but the first approximation would be that's all you're getting rid of. The tax is the same. And it's kind of following up.
The burden neutral?
What?
With the burden neutral.
Yeah, the burden neutral. Because it's burden neutral, after all, it seems like on the aggregate, everything else is the same.
But you should have some allocation across countries that would change.
Yes, well, that's why I said first
That's an
approximation.
efficiency gain.
You get some efficiency gains, some efficiency losses. Due to foreign taxes and credits.
But then you don't get all this income shifting.
Shifting, yeah, the income shifting is.
Well, you have because of foreign tax credits. Well, okay.
You don't waste all those.
Yeah.
You don't have to hire all those lawyers and accountants
To do that. And then
and
there's
investment
the,
bankers.
and then the incentive to exploit.
Pardon?
You're just saying a single overall foreign tax rate is number?
Well, that's
Thinking about that.
what you assumed in the calculation.
Yeah.
And in terms of, in part we were sort of, this was suggested by the international component of Ed Kleinbart's proposal, and that was sort of part of the deal that you eliminate deferral, lower the rate. And but part of the whole calculation is you don't have overhead allocations of overhead like interest and R&D, and that seems to us not unfair because you're including everything in the U.S. tax base. So everything should be deductible. The only question is the only issue is the limitation. So as it is, it's the only margin. The only margin that's at issue is the one that Tom Ludig, or maybe you mentioned, that there's what incentive are you giving countries to increase the rate at the expense of the U.S.? That's the only thing you would sort of worry about by permitting an easier limitation. And in a way, it means that you don't have to lower the tax rate as much.
Thank you. Thank you.